Bell on Wall Street here on this Friday afternoon. IBM ringing the bell on the floor of the New York Stock Exchange. White fiber with the bell pushing the button, let's say, up in Times Square at the Nasdaq market site. It's market domination overtime, giving you full coverage of all the moves to get you up to speed on the action from today's trade. Let's take a look at the market's record highs. Once again, Yahoo Finance's Ines Ferré standing by to break it all down for us. Ines.
Yeah, Myles, another day of record highs for the three major averages, the Dow, the Nasdaq, and the S&P 500. I'm going to pull up a five-day chart here. So the Nasdaq and the S&P 500, third week in a row of gains for both of these indices. And for the Dow, the second week in a row of gains. Taking a look under the hood to see where we're at with the sector action, we've seen the leadership in technology really throughout the year. Utilities was up today as well. Also industrials. Some of these are at all-time highs, like technology, also communication services, and financials at all-time highs. And a five-day chart, you can see the leadership in these stocks here. And over on the NASDAQ, we are taking a look at the five-day chart as well. So you can see the leadership with Apple. Apple today rallying 3%, Tesla up 7%. We've talked a lot about how Apple has really been playing catch-up when it comes to the Mag 7 trade. A year-to-date chart will show you that you still are seeing Apple down 2% year-to-date. But take a look at this. Tesla earlier this week had erased its year-to-date losses, so Tesla up 5% for the year, and Nvidia, of course, taking the leadership role there. But nevertheless, we are at all-time highs again. And by the way, gold, another all-time high for precious metals.
All right. Ines Ferré, thanks for that update. Well, the Fed kicked off its rate-cutting cycle this week. Investors are looking to try to find opportunities past the obvious winners. Ines just walked through some of the names we all know, and maybe look for real opportunities that may not quite be where you think they are. Simeon Hyman joins us now. He's the global investment strategist at ProShares. So Simeon, let's just start with what we heard from Powell, the run-up to it. We got the rate cut, we get the forecast. What your thought was in this run-up to the event, what we heard from him, and how you're looking at the landscape over the balance of 25 now that we have a sense of what the Fed thinks they're likely to do this year, of course, subject to change.
The Fed had room for 2 to 3 25 basis point cuts for sort of free. And what I mean by that is we're still around 3% inflation. 1% above that is kind of neutral for Fed funds. So there is a little bit of room, even if we don't get to the 2, just to the 3, for the Fed to cut a couple of times without risking a real sell-off on the long end of the curve. And I found the sort of insurance kind of language that Powell used to be very consistent with that. We're still restrictive. We're kind of willing to go to neutral. Even if inflation is at 3, neutral meant a couple more cuts could happen. You know,
you mentioned the curve. We've talked pretty much on the show today only about what's going on in the stock market. Talk a bit about what's happened on the bond market and across the Treasury curve, and what those moves say to you about where bond investors kind of see both the path for Fed policy and where the economy appears to suggest it might be headed.
If we get to 2% inflation, the Fed's target, a good guess for Fed funds would be 3. So to get those more cuts from the Fed, we got to get to 2. But a good guess for the 10-year is 4. Well, we're already there. And I think that's what we've seen this week. There should have been no expectation that interest rates would come down at the 10 and the 30 due to that cut. And they didn't. In fact, the long end sold off just a little bit. Skepticism about getting all the way to that 2% number over the course of the next couple of years.
So I'm curious then, if you, like, in your mind, how much of what we've seen in the stock market, we've been very positive the last month or so, has been about the bond market really anticipating this cut, getting way ahead of it. That kind of started with Jackson Hole, but those moves have been, I guess to me, they feel a little more decisive than, I don't know, everyone's just buying a bunch of new AI stuff. Like the 10-year is really saying something about where people think the
I think there's 2 pieces to this. If you look at Q2 earnings season, the Nasdaq 100 grew earnings 28% year over year, and the S&P was fine at 10. Now, if the 10-year bond yield doesn't move too much, large cap stocks aren't going to get that much of a boost, if any, from Fed rate cuts. So it's earnings driven, but the earnings were there in spades. Tack on to that, the claims thing was pretty good this week. So yes, there's a little bit of soft landing in there, but mostly it's the earnings growth that's really come through for large cap stocks.
Now, when we look at that earnings growth, a lot of folks will decompose it to the 493 versus the Mag 7. You look at the sector tilt on the earnings growth. Does that concern you at all that we've seen, such an outsized portion of, an S&P earnings growth that's, what is it now, high singles, low double digits, but most of it's coming from some of these big names we know. Does that concern you at all, or is earnings are earnings?
So I'll break that down into a couple of things for you. First, on the tech side, the one thing that's more robust about the tech side and the tech related, all this stuff that's tech related, comm services, et cetera. The one thing that's kind of more robust there than we saw 30 years ago is that it is a mix of old and new companies. In other words, it's not just upstarts, Palantir's there, but Microsoft is like, 50, 60 years old. So that's kind of a stable thing. Yeah. That's important. But point number two, you do have to worry about, everybody says, relative valuation. This thing is at half of the multiple of the S&P. Yeah. Well, that's just reminding us that the S&P is expensive. That's saying something's relatively cheap isn't enough. There's got to be something else. It's why we think small caps are interesting right now, because that's the place where you only need Fed cuts to be stimulated.
Yeah, let's talk about small caps. We discussed it a little bit earlier. It feels like everyone's okay. S&P, fine, it's going up, but let's talk about small caps. We finally got the Russell 2000, record yesterday. Do you like the setup there? Does it feel like more false hope for a trade that's really just not gotten its act together over the last couple of years?
It's all about, paradoxically, the weaker balance sheets with the debt, with the shorter maturities. You don't have to have the long end move. As long as the Fed cuts, these guys are going to benefit. Yep. So you have two things. Of course, you have the relative valuation benefit, but you also have the component of the boost from the Fed cutting. And look, you put this all in a blender, you got to get some income from equities. Yeah. Because the risk of income just from interest rate sensitive stuff is tricky. So for us, there's a very interesting opportunity with our ETF ticker ITWO to use a call writing approach on the Russell 2000. The innovation here is we do it on a daily basis so that you can get that extra income, but get real Russell 2000 exposure and get some income at the same time.
I'm curious also thinking about the Russell 2000. It's kind of, it's a theory that's been discussed, let's say in the last year, is that we talk IPOs. Companies coming public now, they might be too big for the Russell 2000. Like that life cycle of younger company comes out, faster growing company comes out, joins the Russell 2000, moves its way up, kind of broken a little bit by public markets. Does that change, like in your mind, how small caps fit into portfolios, how people talk about small caps? Is it a different kind of sector? It's not like a graduation sector as much as it is like that's where these guys are forever.
First, I start from kind of what's called an investment policy statement standpoint. Yeah. And that means that your baseline of how much of something you should own is it's how big it is in the marketplace. Yeah. And that means that yes, small caps are smaller in terms of the size of the overall pie than they used to be, but they're still high single digits, so you should have some from a first principle standpoint. But second, and listen, I'll throw out one more idea, so I'll be greedy because we're almost at the weekend. But we have another ETF. It's ticker SMDV, and it's our Russell 2000 Dividend Growth ETF. And that's a nice companion to our I2 idea, specifically for what you brought up. There is a small cohort of small cap companies that consistently grow their dividends, but stay small, and they don't do dumb acquisitions. Yeah. And that's a cool little spot to be an antidote to a little bit of the drying up of the pipeline.
Yeah, and I guess just from like I don't know what perspective this would be, strategy, portfolio management, but you've been able for the first time in a while, last couple of years, to go into fixed income, get 4 or 5%, feel pretty good about it. That feels like it's not going to totally go away, but it's going to shift. Are you looking for, it sounds like you guys are thinking about other ways to get more income from the stock market that investors didn't have to think about as much when I'm in a high yield savings account getting 4%.
That's absolutely true. In fact, I was talking to a bunch of clients and folks this week and doing the usual, the lunches and the dinners and the steak places, and several of them said, that 4%, that's an emotional trigger for our clients. When they start getting less than 4% on the money markets, they're calling us and saying, what else should we do? Yeah,
there you go.
Absolutely.
All right, we'll leave it there. Simeon Hyman with ProShares. Really appreciate the time. Have a good weekend. All right, well, Apple's iPhone 17 now on sale around the world. Our tech editor, Dan Howley, got a closer look at the new devices.
The next generation of Apple iPhones are here. and they include the iPhone Air as well as the standard iPhone 17 and iPhone 17 Pros. It's been about 8 years since Apple launched the iPhone X in 2017, and since then, the design of its big-time phones have kind of stagnated. Sure, they've updated the inside with new chips and made the cameras better, but really the look and feel of the phones has remained mostly the same until now. There's a ton of big deal changes to this, but there are also a few trade-offs, so let's go through them. This is the iPhone Air. It is the latest iPhone, new design, incredibly thin at 5.6 millimeters and incredibly lightweight. Now, I know those numbers might not sound big, but when you hold them next to something like the iPhone Pro Max, it really does feel like a different kind of device. Inside, the phone has Apple's new A19 Pro processor. Basically, it's the latest version of the chip that runs in all iPhones. The Air, unlike the Pro or the standard iPhone 17, has just one rear lens. So it's not as though that's bad, but if you're the type of person that really likes to get a macro shot or really zoom in, that could be a deal breaker for you. On the 17, we have a standard zoom as well as an ultra wide, and then on the 17 Pro Max, we have a new 8x telephoto zoom, which is the furthest that Apple's offered so far. And then up front, they have what's called a new center stage camera. Now, the big deal here is that unlike prior versions of the front-facing selfie camera on the iPhone, where you had to kind of turn it sideways to get a vertical view, or rather a horizontal view, this does it automatically. So you can just press a button and it'll immediately turn to landscape. It's got a good, decent amount of battery life, but the problem is that the 17 and 17 Pro also get big updates for their battery life, and they're going to last with the 17 Pro Max up to about 39 hours. One of the other things that I think is worth pointing out is all of these phones now come with Apple's iOS 26 and their new liquid glass design. Finally, pricing. Let's talk about that. The standard 17, that starts at $799 still, no difference, but you do get 256 gigabytes of memory, up from 128. The Air, that starts at $999. So not exactly going to break the bank for a new design. Very cool to see that. It's slightly more expensive, though, than the Plus was, which the Air replaces. The Pros, though, get a little bit more expensive at the start. Instead of $999, it's now $1099 for the base Pro and $1199 for the Pro Max. So not as much change as far as the pricing goes overall, but it's definitely something to keep in mind. From my experience, I really like the Air. I think the photo quality is great. I thought the battery life was great, especially compared to last year. Basically about the same performance. So overall, it's a big moment for Apple. They're finally changing the design of the iPhone. And if they follow the same pattern that Samsung did, they released a super thin phone and then released a super thin foldable. There have been rumors for a long time that Apple's working on a foldable, and it just released its first super thin phone. So now we just have to see if there's a foldable in Apple's future.
All right, coming up, e-commerce firm Pattern going public on the Nasdaq. We're going to speak with its CEO. Stay with us. It's a conversation you won't want to miss. We'll have more market domination overtime coming up right after the break. All right, e-commerce firm Pattern went public on the Nasdaq on Friday, stock gaining more than 11% during the session. Senior reporter Brooke DePalma spoke with Pattern co-founder and CEO David Wright earlier today.
Now, you did start this company over 12 years ago. I believe it was over lunch with your co-founder, Mel, that you began chatting about this moment right here. We've seen such a streak of IPOs lately and the success of them. Were you just trying to strike while the iron's hot right now?
Well, we've been planning it for quite a while. The core driver for us on the IPO front is, we have, if you look at the balance sheet, we have $215 million in cash, no debt. So we don't need the money, but what we couldn't do, we couldn't compete with the Googles, the Amazons of the world on AI and tech talent, which is core to our, is what we're built on. So we needed to take fake money and turn it into real money for the team.
Now, you say that you've been doing AI for a long time. It feels like that's all we've been talking about lately, though. What has this recent momentum, especially with all those other companies now, Amazon, Google, all really touting about it? What has been the momentum lately for you, since you've already been doing it, it seems?
Yeah, I think that's been, in the machine learning, natural language processing world, the folks have been doing that for years, like our team. I mean, we had patents that were AI patents before anyone ever even talked about it. And so it has been fun. It's really the transformer model that has changed the game, and it is game changing for e-commerce. If you think about it, it's very content centric, text based, content, and the impact that you can have in a consumer journey world with good content or slightly better than content than a competitor. Because what we do for brands is we help brands grow across marketplaces around the world using a technology and AI stack that has, we've invested 142 million in it. We have 400 people working on that, and but it's a global problem to solve.
I do quickly want to hit on that because when you think about consumer behavior, what we saw, especially in the August retail sales, was non-store, so e-commerce platforms see a growth of about 10% in the month of August alone. But consumer behavior seems very hard to navigate right now, especially with all the noise of sponsorships. You also have this algorithm that brands are trying to beat. So how do you guys play a role in that?
Well, the core of the technology stack, the way we calculate revenue is just a formula, right? So revenue for a brand is traffic, eyeballs to a product or listing. Conversion, can you convert it? At what price? And is the product available close enough to the consumer? And then you want to be in a place where you're chosen. Consumers have a lot of choice today, and we want our brand's products to be first on their list.
Now, one of the platform's initiatives as well is really accelerating brands on a global platform. You guys are a global company, specifically within the China marketplace. How exactly are you navigating the current landscape that we're seeing right now with your clients?
Well, I mean, they've been so far. We've had great success in China. We have about 200 people there. We continue to build the platform, and for us, they've been very friendly, great relationships, and we've been very successful there.
With the de minimis policy ending, has that impacted any of your clients, and how are you navigating that?
It hasn't impacted us much. That's more importing. When we take goods from a brand, generally it's millions of dollars, not smaller amounts. So we haven't really had an impact with the de minimis.
I do want to take a step back because consumer behavior right now seems really hard to navigate. I see people that I've spoken to, like a PwC expert, Ali Furman, says the consumer really has to be convinced to buy right now. They're really seeking out value. How are you working with your clients to find the right price point that will really succeed in getting clients to buy the merchandise?
Well, for us, it's just all mathematical. So we don't know exactly how to drive home the great branding. I mean, that's what our brands do, and they build great products. But if you have a great product, you will have mathematical propensity to win in a marketplace. And that's what we do. So we actually, the formula works much better with a great product that really resonates with the consumer, because you have a much higher mathematical propensity to win over a consumer.
Yeah. Really quickly, in the next 5 years, what are you looking forward to most, especially with this run-up of AI and this momentum that we're just gaining now?
Oh, we have a couple things on our list. One of them is that's sort of just fun to talk about. It's a good rallying cry. Is we have in Utah, there hasn't been a Fortune 500 company in like 30 plus years, I believe, is the number. And of course Idaho has a couple, and Arizona has like 8, and Texas. So we want to put Utah on that list, and I think we're on path to do it. So that's a fun rallying cry for the next few years.
All right, time now for what to watch, starting off with the S&P 500, which will look a little bit different on Monday's opening bell. EMCOR, Robinhood, and AppLovin are set to join the index. The three companies will replace Market Access Holdings, Caesars Entertainment, and Enphase Energy prior to the start of trading on September 22nd. Taking a look at the earnings calendar, some big names reporting include Micron, Accenture, and Costco. Costco announcing results for the fourth quarter on Thursday. Analysts are expecting Costco's U.S. and Canadian stores to do well, and overall sales to rise by mid to high single digits in the quarter. But international sales have slowed for 3 straight months, hitting their weakest point in almost 2 years. Moving over to the Federal Reserve, at least 11 different Fed officials are set to speak next week, including Fed Chair Jay Powell. Now, the Fed cut interest rates by a quarter point at the end of its September meeting last week, and investors will be keeping a close ear on comments from newly minted Fed Governor Stephen Myron, who will speak at the Economic Club of New York on Monday. And speaking of the central bank, the Fed's preferred inflation gauge, that's Personal Consumption Expenditures Index, is set for release on Friday. Economists are forecasting headline PCE rose 0.3% in August, while core PCE is expected to rise by 0.2% over the prior month. And that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow on Monday at 3 p.m. Eastern for all of your market coverage leading up to and after the closing bell. But don't go anywhere on this Friday. On the other side, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market moving stories. Stay tuned.